We're going to talk today about the basics on rentals. If you are renting out a house or apartment buildings or anything like that, and making income off of renting that, then you have a rental income, and that is taxable income. If you do have rental income, it is gross taxable income, and you're going to report it on Schedule E, Part 1, which is on the front of the Schedule E. And the back of the Schedule E has other types of things that go on there, such as if you invest in a partnership or you invest in an S corporation, then those things will go on to the back of the Schedule E. Otherwise, but we're just talking about rentals, so you only have to worry about the front of the Schedule E. On vacation homes, if both the personal and the rental use of the residence, you must allocate the expenses. So if you have a vacation home, maybe down at Hilton Head or something, and you rent it out sometimes, and sometimes you use it, or your friends or family uses it, sometimes that's personal use, you have to allocate. You can't subtract all of your, say, utilities or maintenance costs on that because you got some personal use of it. Deductions are limited based on the period of time that the residence is used for personal versus the amount of time you used it for rental. If the property is only rented out and never used personally, so you have a rental house in Orangeburg, you just rent it out 365 days a year to a family, you don't use it personally, then all the deductible expenses will be subtracted from the rental income on Schedule E to arrive at net rental income or net rental loss if the expenses are more than the income. So there's no problems if you rent this out only and you never use it personally. If there is net rental income, it is transferred to line 5 on Schedule 1 and is taxable. However, unlike our Schedule C, self-employment income, remember that had to be put onto Schedule 1 and it had to go to Schedule SE for the self-employment tax calculation. Well, here with rentals, it's only going on Schedule 1. It is taxable for regular schedule tax, but not taxed for self-employment tax. So you do not need a Schedule SE. If there is a net rental loss, it may be restricted. There are things called passive activity loss rules, and we may have to not be able to take all of the loss. And when we get to that section, and we'll see how to fill out the 8582. But on the Schedule E, you would show the net rental loss, but then you're going to have to fill out an 8582 if you have a loss. And then that will tell you if you get to actually subtract the loss on your Form 1040. Also notice on here that if you do have net rental income, it is not considered earned income. So you cannot use it, say, for the Form 2441 daycare credit, nor can you use it for the earned income tax credit. All right, if you have a house with a dual purpose, meaning part of it is rented out and sometimes it's used personally, and they use the word vacation homes. for this. There are 3 categories, and there's a different tax treatment for each category. So category 1 is primarily personal use. This is your home. You live in it, but you rent it out for less than 15 days during the year. This happens like you have a house in Clemson, and the Clemson Carolina game is going to be up there. So you rent your house out to somebody else for a couple $1,000s for the weekend, and you just take off and go somewhere else. And so it's primarily your home. You live in it all year, but you've rented it out for this maybe 3 days or something. That is a primarily personal use, category 1. Now, category 2, primarily rental use, this is where you rent it out more than 2 weeks, but you don't use it more than 2 weeks. You use it for 2 weeks or less, or 10% of the rental days or less. Okay, and so in that case, it would be a primarily rental use, category 2, and there's a different way of handling the expenses on category 2. Category 3 is where you rent it for more than 2 weeks, but you also use it for more than 2 weeks, or 10%. So let's take a look at category 1. This is a primarily personal use. The rental itself is less than 2 weeks, but the personal use is more than 2 weeks. This is treated as a personal residence, and the rental period is just completely disregarded. This is one of the few times when you can make some income and it's totally legally not taxable. So you rent your place out for the Clemson Carolina game weekend, and that's all it is, and you live in it the rest of the time. You just disregard. Now, you can't subtract any expenses. You're not even going to fill out the Schedule E. Whatever money you made for that weekend from renting your place out, you just keep on holding on to it. Do whatever you want with it. It is not going on your tax return, but neither are any expenses going on your tax return. If you do itemize your deductions and you have mortgage interest on that house, well, that is, as we learned in previous chapter, that is acceptable itemized deduction. Real estate taxes are also an acceptable itemized deduction on Schedule A. So if you itemize and you have those kinds of things, then they are, even though this is rented out that weekend or whatever, you take the whole amount of the real estate taxes and the mortgage interest and put them on your Schedule A. Of course, if you don't itemize, if your itemized deductions are less than the standard deductions, well, then you take your standard deduction instead. Any other expenses that you have, repairs and maintenance on the house, and anything like that, those are personal, non-deductible. You're not, like I say, you're not even going to fill out a Schedule E. Let's take a look at category 2. This is the primarily rental use. So the rental section is more than 2 weeks. The personal section is less than 2 weeks. So in this case, we need to allocate the expenses between the rental part and the personal use. And we calculate this as follows. We take the how many rental days divided by how many days used, not how many days in the year. So let's say you had some beach house and the total days it was used all year was 100, not 365. It just sat empty for 265 days, but it was used for 100 days. Out of those 100 days, 90 of the days were rental days. And so 90 divided by 100 would be a rental percentage of 90%. And you would take all your expenses and you would multiply it by that 90%. So your repairs expense times 90%, your utilities expense times 90%, your real estate taxes times 90%, etc. All of those expenses, every expense you got toward that house, you multiply by 90%, and that's your rental deductions, and that would go on Schedule E. Then your personal days, if you used it 10 days for personal, divided by 100 days used, that's 10% for personal, okay? And you would multiply all of your expenses times the 10%. Now, the mortgage interest, 10% of the mortgage interest could go on Schedule A if you itemize, and 10% of the real estate taxes could go on Schedule A if you itemize. All the rest of it, utilities, etc., that 10% is you can't use it on anything. Now, if the rental deductions exceed the rental income, let's say we have $5,000 worth of rental income, and we have $5,500. After we calculated out the 90%, we ended up with $5,500 of rental deductions. Well, $5,000 of income minus $5,500 of expenses is a negative $500. We would have a loss. Now, other than the passive loss rules, which we haven't talked about yet, if they don't restrict our loss, then we can show that $500 loss. We can subtract that $500 loss against our W-2 wages or our interest income, whatever other incomes we have. That can be subtracted. Now, the passive loss rules might limit that loss, and we might not be able to subtract that loss from our other incomes. We might have to wait until we actually sell this vacation house, then we could subtract all the losses then. Okay, here we're talking about category 3, where we have some rental use more than 2 weeks and personal use more than 2 weeks. Okay, and so we here we have to allocate the expenses between the rental part and the personal part based on the same allocation formula we used in the previous screen. Okay, where you take the rental days divided by the total days you used it, and you take the number of personal days divided by the total number of days you used it. That gives you your percentages. Okay, only now, since the personal use is pretty high, we can only take certain expenses. We can't show a loss other than mortgage interest and real estate taxes. If they're more than the income, then we could take a loss. Other than that, we can only show 0. Okay, and so, and we have to put these things in order. So we have to calculate out the real estate taxes and the interest times the percentage that's rental, and we subtract that from the income, the rental income. If we have a positive number left, then we'll look at the utilities and maintenance stuff, and we multiply that times the rental percentage, and we subtract that from whatever is left over of the rental income. If there's still a positive number, then we'll calculate out depreciation and multiply it by the percentage, and then we can subtract that as long as it doesn't bring us down below 0. If, let's say, we only have $3,000 of rental income left after we subtract out utilities and maintenance stuff, and then we calculate out depreciation and it's $4,000. We only have $3,000 left. We can only subtract $3,000 of the depreciation. The other $1,000 cannot be deducted. Okay. Now, the personal usage of the mortgage, interest, and real estate taxes can be reported on Schedule A as itemized deductions if we itemize. But the rental portions, we have to follow that little rule. So let's look at an example. Here's the Pravina family owns a ski condo in Alta, Utah. In the current year, the personal use is 25 days and the rental use is 50 days. So the personal use is more than 2 weeks and the rental use is more than 2 weeks. So this is a category 3. Data pertaining to the rental follows. And it wants to know what amounts will be reported on Schedule E. So the rental income was $10,000, taxes $1,500, interest $3,000, utilities $2,000, insurance $1,500, snow removal $2,500, and depreciation we calculated out would be $12,000 for the house, for the condo. Now, since we have category 3, okay, we have to allocate the percentages. So again, we have we have 50 days of rental use. We have 75 total days that it's used. So 50 divided by 75 is our rental percentage. 25 days of personal use divided by 75 is our personal use. So we have 2/3 is our rental use and 1/3 or 33% is our personal use. So I am going to first take the taxes and interest. So I got 1,500 times 2/3, and I got, and that would be 1,000, and interest 3,000 times 2/3 would be 2,000. Okay, so 1,000 I'll get to take of rental for the taxes, and 2,000 I get to take for interest. Okay, so we can see the total taxes and interest was 4,500 times the 2/3, the 50 divided by 75 is 3,000 total that we can deduct on Schedule E. Now we go back, we take a look, our rental income is 10,000. If I subtract out that 3,000 that we calculated, there's 7,000 left. So now I'm going to look at various other expenses that my utilities, my insurance, and my snow removal. So I got 2,000 of utilities, 1,500 of insurance, and 2,500 of snow removal. Okay, so that totals up to $6,000. I multiply that times my rental percentage, okay, and 6,000 times 2/3 is 4,000, and I'll get to deduct that on Schedule E. Okay, so remember that I had 10,000 here. I can deduct 3,000 for taxes and interest. That brings me down to 7,000. I could deduct 4,000 for these things. So 7 minus 4, I have $3,000 left. Okay, so if I take the 12,000 total depreciation times my rental percentage, that's $8,000 of depreciation. However, I only have 3,000 left that I can use. Okay, and so I will show on my Schedule E, I'll show the 10,000 income. I'll show these 2/3 pieces of all these expenses, and I'll come down to 0. I cannot create a loss on a Category 3 type thing. Now, as far as Schedule A for my personal section was 1/3. Taxes and interest together is 4,500 minus the 3,000 rental or times 1/3. Either way is 1,500. If I itemize deductions, I'll be able to use 1,500 from this house as deductions on Schedule A. If I don't itemize, of course, then I will not be able to use that 1,500. I also cannot use any of the other expenses, the utilities and snow removal, depreciation, all that kind of stuff. There's nowhere for me to subtract any of that of the personal part of it. Okay, let's take a look at categories of income. There's 3 types of income. Active income, and this, another way we've talked about this in class, is earned income. So very similar, wages, salary, self-employment, things you had to sweat to get. That's active or earned income. Then we have portfolio income. This is a type of income generated from dividends and interest. And we've had various tax return problems with where we've gotten dividends, we've gotten interest, and so all of that is considered portfolio. It's like from investments, okay? And now we're going to learn about passive income. Passive income is if we invest in a limited partnership and we're not one of the partners making the decisions, we're just invested in it and we just sit at home and collect whatever income we get from the partnership, and we get a K-1 that has to go on to our tax return. That would go on the back of the Schedule E. Rental real estate is automatically considered passive income unless that's what you do for a living, and we'll talk about that later. The passive loss rule says that when you have minimal or no involvement in an activity, mainly you just invested money in it, but you're not making decisions, you're not actually fixing toilets, you're not doing stuff, okay? Then those losses are considered passive. Like you're just passive, you're just chilling, you're just collecting whatever from your investment, and may not be deducted in excess of passive gains. So if some years you make money on that rental income and some years you lose money on it, then when you lose, it can be subtracted against the gains that you have gotten in the past. But you can't have like loss after loss after loss year after year. Okay? However, the losses that you can't use can be carried forward and deducted in the future. So when that rental house is sold, then at that time, you can take all those losses you didn't get to take. Now you can all of a sudden take them, because when you sell that house, that's when you're going to make your money. A lot of people invest in a rental house, not really because they expect to really make money year by year, but because they make money when that house is sold. That's when they make the money. So, at that point in time, all these losses that you didn't get to use year by year, you will get to subtract it from that big gain that you have when you sell that house. Okay? The passive losses can also be deducted in the future if you have some gains from that house. Then the losses from the past can also be used against the future gains. You cannot use passive losses to offset active or portfolio income. So you can't subtract it against W-2 wages You can only subtract it against other passive gains. In other words, if I made money on the rental house last year, then that's a passive gain from last year. And so that gain is in there, and I can subtract, or I have passive gains this year on one rental house, and I have passive losses on a different rental house, then I can subtract that passive loss against the passive gain. Okay, but I can't subtract the passive. If I only have one rental house and I have a passive loss, I cannot subtract it against W-2 wages or interest and dividends. Now, rental property itself is specifically designated as passive. It's automatically considered passive, even if you spend time making decisions and fixing the toilet. Okay, however, there is a little loophole in which an individual taxpayer, so if you're incorporated or something like that, then this doesn't hold to you. But if you're just an individual person and you own this rental house or two, okay, you can take up to $25,000 of rental loss against your other regular incomes like wages and stuff. It is that capability is reduced by 50 cents for each dollar of modified AGI, called MAGI, that is greater than 100,000. Okay, so if you make a lot of money, then you don't get as much of the $25,000 rental off. So this is mainly there to help middle income individuals who happen to have a rental house and they got a loss from it to be able to use that loss right now instead of waiting until they sell that house. Different rules apply, however, if you're married filing separate. One more time where married filing separate works against you. And you need to file a Form 8582 if you have any losses, and then it's got a section to go through this if you're an individual thing to be able to subtract it. If the taxpayer is heavily involved in real estate rental activities, like this is their business, this is what they do for a living, then they can call the rental activity an active business. And the requirements for this are that more than 50% of the time you spend doing stuff is in real estate property trade. And you spend more than 750 hours of that kind of service. The taxpayer then will be able to deduct the entire loss on real estate business. You're going to use a Schedule C. This would be concerned earned income. If you have income, you're going to have to pay self-employment tax on it. Okay, but if you have a loss, you'll get to take the whole loss. You get to subtract the loss against W-2 income, etc., like that. You won't have to fill out the 8582 for your loss.